now we have been talking about stable coins from different points of view, CBDCs, and let us try to understand better which are the things that we can learn for the future about them. And there is now one better in this community than Professor Ali Nejadmalayeri, who is the chair of banking and financial services at the University of Wyoming. Ali, it's a pleasure to welcome you to the conference.
Thank you. Thank you for having me. First of all, my heartfelt thanks, Professor Shinshiro Matsuo and Professor Claudio Tassone for giving me the opportunity to share my thoughts on the topic. Obviously, I'm not in the thick of things. I have the advantage of sitting back and be critical about what everybody else does and not take responsibility for it. So with that, as an empiricist who looks at how the world evolves, I'm going to give you a flashback. Not 5 years ago, stablecoin market, total market cap was about $20 million, all represented by Tether. On the eve of April of this year, 22, it was around 180 billion, hundreds of stable coins, the largest is still Tether at about 183 billion, and the third largest, something completely different from Tether, third largest, Terra with 18 billion. In a span of about a month, the whole world changed. At the time of writing this, in June 15, there is no Terra. In fact, its sister crypto doesn't exist. That's a total loss of almost $50 billion. Tether is down to about 66. Quite a bit of that is flight to quality, and that quality is represented by the rising sun USDC. So why do we need a stable coins if this happened? Because since basically mid-90s, we have moved to the dawn and now the whole world of digital commerce. If things and services are moving at speed of light or close to it, then the money that represents that exchange should also move at the same exact speed. Unfortunately, the money moves very slowly. And that's the gap that the stable coins basically fill. In order to do so, however, whatever is the mean of exchange and whatever how you want to call it, it has to have low volatility, such as cash. It has to be widely accepted. That includes multi-dimension of what widely accepted means: interoperability, adaptable, adoptable, and it has to be near as good as cash money. That is, no question asked about its provenance. Those are very high bars. Now, as a whole, how did industry has sort of performed? This is a plot of about, little, not exactly a decade, but pretty darn close to it. You can see the volatility of the largest crypto as opposed to the largest stable coin. By all accounts, stable coins, despite all the troubles, have been extremely stable. Even the graph sort of shows it. As we stand, this is the top 10, so to speak, of the stable coins. Tether still stands highest, but not as high as it was. USDC pretty darn close. And the thing that is interesting about this list is that majority of these are what you could classify as fiat-backed stable coins. Mm-hmm. Even the ones that are algorithmic, such as DAI and Frax, they do have collateral. It's not exactly fiat-backed, but they do have collaterals. And especially for DAI, they sort of adhere to the over-collateralization. So when the collateral is not exactly as good as cash, they actually demand more for what floats out there. Which brings me to the next thing. There are three things that a stablecoin needs to address. One, since it's trying to pretend to be cash or fiat, then it has to define how that peg is characterized. How do they do it? If things failed, what should happen next, et cetera, et cetera. Second, is this thing done mechanistically like USDC, or is it algorithmic? Are you trying to write a code that incentivizes behavior, buy and sells, hence brings a sort of a semblance of a stability, or is it back one-to-one so you can redeem it at any point in time? And lastly, very related to the second point, how does collateralization actually work? If you don't have a backend, then what brings collateralization and how could that fail? And when it fails, then what's the exit strategy? So what are the pegs? Obviously, we had to talk about the one that is backed by basically dollar, but it doesn't have to be. It could be anything you want it to be. So anything can become digitized, sort of a asset if you want. It could be gold, it could be US dollar, it could be euro, whatever have you. Why is this important? Next slide, what I get into is that the currency that they choose to digitize defines the depth and the liquidity inherent in that system. So if I'm trying to basically represent, for instance, Venezuelan currency, I got to be out of my mind. This currency doesn't have the depth nor the liquidity. So that's the risk I run by designing a stable coin, something that I cannot sort of escape from what I have designed. So how is a non-algo or a fiat-backed stable coin stability arrives? All it is you park your money in a bank account, someone issues a digital claim, and then you take that claim and run with it. So long as money is in the account and they don't do anything with it, they don't lend it out, they don't use it as collateral, et cetera, et cetera. So siloed only for your use, then you should be able to redeem this at any point in time. It's as good as cash. Theoretically, there is no risk in that. So those are some of the things that obviously has to be understood when you design a stable coin. This is not your money. And I think that's where lines gets crossed, that people think just because I brought this as an asset, then I'm free to do whatever I want with it. That's not true. One of the things, from Circle's white paper, as you can see, the whole reason for existence of stable coin is that it brings price stability. This price stability has to have the ability to have a very large pipeline. You're trying to behave like cash, so you better be able to behave like cash. And lastly, it does need very strong governance. I need to be able at any point in time to basically give you a snapshot of what is on the other side of my digitized currency. You should be able to see exactly sits in my books. One of the things that get lost in all of this is that not any two stable coins are created equal, even when they say they are riskless and fiat backed. And nothing better than these two graphs are going to represent it. This is Tether, the largest one, and this is USDC, the second largest. And as you can, see, this only goes. Sorry, wrong button. In April of 22, what you can see is there's about 3% drop in the peg for Tether. That's 3 times largest than the largest worst days in any currency in the world. So this is by all accounts is a calamity for someone who claims that they have a peg. But what's more important is, as you can see, is a crash in market capitalization. That's a flight of quality if I ever saw one. And if we turn back and look at the other one, the USDC, you see the exact opposite. An almost 2% rise in the peg, not loss, and then a continuous rise in that flight of quality coming in to this stable coin. Why? Well, I got to go back to the slide that I had before, so bear with me. Tether basically tells you that they hold short-term, high-quality assets. That includes commercial papers, that includes loans, et cetera, et cetera, et cetera. More importantly, up until lately, you couldn't even see what the breakdown of that asset structure is. So when it comes for time of crisis, which I need to know, what is your capability to liquidate that asset and give me my cash? This is the greatest red flag. You hold assets that by nature are illiquid. So can you really liquidify that asset? Whereas the other ones, as you can see, short-term government bonds and cash, 20% cash and 80% short-term treasuries. I mean, worst case scenario of a run that I have, 20% coming in, I'm sitting on cash. I can observe that 20% and not blink. The closest that we have to these things are an older, about 50-year-old instruments, money market funds. Almost 50 years ago, US had a regulation Q, that capped what bank could offer on deposits for longest time. And it was all okay until the inflation, which now we see in late 60s and 70s kicked in. So in a hurry, that 6.7% ceiling became a disaster. While Treasury bills were lying at 18%, you had to accept that the only thing bank could offer you is less than 7%. Most institutional money needed to fly out. So where did they go? To ungodly market was created. €1 every institutional dollar basically flew to London and then gets transacted at current market price. But this also was the dawn of investment industry. The mutual funds were invented and they needed to be traded, et cetera, et cetera. I've got to account for my retirement. When I liquid one fund, it goes to a money market, and then I tell them where to go else. They have an encapsulated system. They don't need to touch banking system at all. So that regulation Q created basically the instruments that grease the wheel of the entire investment industry. What characterizes these things? They're basically as good as cash for that particular ecosystem. They tell you specifically what their investment strategy is. They reveal full disclosure down to the ID of everything they hold. They are regulated, perhaps the second highest regulated segment of the financial industry, and they are audited by some of the highest respected auditing firm in the world. Yet still, this industry had a panic attack in 2008 because one fund couldn't liquefy fast enough to pay its redemptions. The whole industry went into a tailspin. So even when you meet all the requirements, still at the end of the day, there are concerns. When there is a perception of concern about counterparty and operation risk, all bets are off. So then this gets us to algorithmic stablecoins. These things, by no stretch of imagination, have anything remotely close to a fiat back. What they do, they basically create environments, codify rules with which it promotes either buy or sell of their own sort of a stable coin or whatever backs it in order to bring a stability back. That's all good so long as you can effectively incentivize that behavior. All right, so why do we need the algorithmic if it's not backed? This is, I think, well, I sort of depart from majority of the thinking. The algo stablecoins represent the ethos of DeFi and crypto. If you think about I need digital money, then digital money has to be digital. It has to be programmed. It has to be codified. It can't be real, can it? Then what's the point of it? If it's just a manifestation of the real one, then it's not really digital money. More importantly, in this framework, there's no pesky central bank because I created the money and I govern the way with which goes back and forth. There is no need for a trusted third party. Now, I'll put it with question mark, but nonetheless. One of the things, however, is that this is not foolproof. There are disadvantages. One, that in order for them to operate, especially in case of DAI, you do have to create a governance mechanism. The governance mechanism is not as democratic as you think it is. In fact, that's one of the advantages of the ones that have survived this storm. They did have a lot of control over how the game is played. More importantly, in order to bring a stability, they have to rely on market forces. I don't think anyone that controls market forces, not even the Fed. So this is a really big deal in order to demand the stability. Now, when we look at these two, both DAI and Frax, which survived the storm, as you can see, initial negative reaction, positive reaction, then life is good. They did lose a lot of market value. So did Frax, which comes back to, it doesn't matter whether you can maintain peg or not. When that trust is broken, then you will face flight to quality. All right. So I think there is a missed opportunity. In fact, if you ask me whether I believe it or not, emphatically, I will tell you absolutely 100% yes. Why? Algorithmic stablecoins are not stablecoins. They are synthetic cash. Why is that important? Because they're created not via a bank account deposit and then I issue a claim against it rather from literally thin air. That's a derivative. And if you accept that premise, then the power of a stable algorithmic stablecoin is exactly in that thing. They are derivative. They are the only synthetic cash, which basically means they're the cornerstone of financial engineering in the digital world. They should embrace this, not escape from it. They should step away from calling themselves a stablecoin because that's a handicap. Now, to prove this to you, there is an obsession to be the next fiat. I think that's absolutely wrong. The entire money market fund in the world is 8 trillion. The bond market, on the other hand, is 128 trillion. And if you don't think that's big enough, the entire derivative market is 1 quadrillion. If I was a betting man and I want to bet on a market, I don't care about the 8 trillion. What I want is a piece of that 1 quadrillion. So if you are the cornerstone of 1 quadrillion market, why would you waste the opportunity to be the cash? Digital commerce is all about a speed. Why? Because time is the only truly priceless asset. When you spend it, it will not come back. Not at least in our world, in our universe. There might be some nonlinear universe somewhere else, but we don't have that. Since time is the only priceless asset, then we have to think about this. If you want to become a speedy, what is the cost of a speedy? I'm going to give you an example. My grandmother would tell this story to me all the time. I had to walk half a day to get water, to bring it back, to boil, to cook, so people can, I can feed people by the end of the day. How did we solve this problem? Everybody had their own river and their own wells. They had absolute control, privacy, all of that. What did we do? We gave up all of that. We built the infrastructure. We brought the water to the tap. So instead of taking you half a day to get the water, you move 2 minutes and you get your water. Done. The lesson and what I'm trying to say is this. You demand the speed, then you have to give control up. Because I have to build infrastructure to basically do aggregation of common functions. So on aggregate, we can save time. Now, any financial system lives with one devil, fragility. There is no way that you can get away with fragility of financial system. This is life in financial world. What that means is you have to be prepared for the downside. This is not a laptop that crashes, you reboot it, and all world is correct. No. This downside, when it happens, it takes away the entire life saving with it. And I cannot guarantee you someone who basically is facing all his saving gone, what's going to do next. Quite a lot of people take their own lives. This is not a joke in financial markets. The downturn is very serious, and it has to be treated as such. So how do we treat it as such? Warren Buffett famously said, it takes a lifetime to build a reputation and one night to lose it. It cannot be more true for financial systems. You can be the greatest promoter in the financial world, and one instance is going to take you away. I showed you the picture for Tether, and that's not even a huge disaster. Just one hiccup for one day, and they lost $20 billion of market cap. You have to build a system that is vigilant, is trust building and keeping it. Full disclosure, adhering to the regulatory standards, et cetera, et cetera. All of that does is that it tries to solve that trust building and keeping puzzle. And at the end of the day, you have to trust, but at the same time, you have to verify. That's the irony. I can trust you, but not really. At the end of the day, I should be able to verify what you basically say. So counterparty risk is detrimental. I know we throw around the know your customer as something that we have to do because it's our regulators demand it. But in this world, it's not because regulators demand it. It's because if you don't, then the customer goes somewhere else. Runs would happen. The only way you can, or the only thing you can do is to slow it down and mitigate it. So this sort of obsession with the speed, when a crisis happens, the last thing you want is speed. Take Every major financial crisis, LTCM, 2018, et cetera, when you take a breather to actually look at the big picture, that's when things fall into place. But every time you force liquidation, you want to be done because you're scared, you just make it worse and worse and worse and worse. And lastly, something that I said before, all the obsession has been about payments. That's okay. But cash is not, when you think about payments, is that, you know, I'm sending you money for what you delivered to me, service, good, whatever it is. But that's just one thing that cash does. Cash does a lot more than this. Cash is a conduit for transferring one risky asset to another one. When you sell a stock and you want a bond, what are you doing? You're taking a stock, you're making it cash, then that cash becomes the other asset. That's the conduit that moves wealth all over place. Asset transformation. When you deposit your checking account and you're withdrawing, right? I mean, the money comes in for your paycheck and then goes out at the end of the month. Yet the banks use that to build a 30-year mortgage. That's a maturity transformation. I time displace different types of assets. And lastly, financial engineering, which I basically showed you the numbers. You take, for instance, swaps, credit default swaps, interest rate swaps, et cetera, option markets. All of these are basically re-engineered portfolio of assets based on other financial assets. But at the end of the day, the only way that puzzle gets solved is that a portfolio of synthetic assets combined with equivalent offsetting position of its building blocks always turns into cash. Hence the reason why cash is the cornerstone of financial engineering. So what I want to leave you with is that this obsession to become the next fiat in the immortal world of Borg is futile. You should leave that alone. There's a much greater world right across the horizon, quadrillion large. With that.
Thank you very much. That was the way of finishing it. Questions, people. Bernhard.
Thanks for this very exciting talk. Actually, I would like to ask you the same question I asked the first speaker. So let's assume for a moment that users lose trust into stablecoins. And I can think of many scenarios. For instance, people might question the companies behind. People might question if deals are really scalable enough for payments. But let's assume that people lose trust and within 2 days, 50% decide to withdraw or redeem their Tether or USDC. Sure. What happens? Can you explain this in very simple world to a computer scientist?
Sure, absolutely. So that's a great question. Now, a run is only a run when you do it against the fractional reserve system. If you have a fully backed system, there's no such a thing as run. What you have is illiquidity risk, not run, because it's backed. So as long as I can basically liquidate and give you in a form you want, then we're fine. Now, when you are in a hurry, you might not get 1-for-1 because I can't liquidate that fast. That's the risk that any system runs, right? So a stablecoin that is backed has to observe that. At 20% cash, based on what I understand these crises to be, is well enough to capture a majority of a run or initial hit of a run. And when you do that, you basically bring calm to the market since everybody got paid and moved on. Then you get to the business of liquidating. If you're holding very liquid assets, then the haircut is very minimal, probably not, and then you can pay that back. So your question is valid. However, for something that is fully backed, is not a extremely worrisome problem. That becomes a problem for something that is not backed or is trying to synthetically create that backing. That could be a severe problem. And with the experiment with Terra shows you that it could go out of hand in a second.
Fantastic. Thank you. Luis has a question online.
I have a question, and thank you very much for such a wonderful presentation. I have a question regarding the comparison that you just mentioned about the stable coins, the different types of stable coins, and the current monetary banking system, like two-tier banking system. That, I mean, I just want to compare that in essence, they're not so different. Just in my opinion, the main difference is that one is legal tender money, but the other one is just a financial engineering scheme, as you perfectly mentioned. So the thing is, if we had a bank run in the current monetary system, the amount of shadow banking that is not fully covered by narrow money is so big that the current system couldn't accommodate it neither, as it happened in the case of, for example, 2008, where central banks, where the Fed had to accommodate the mortgage-backed securities in order to stabilize the economy. So the reaction here is not different in stable coins than the current monetary banking system that we have. Just that there's a big like communication, there's a big movement saying that they're all Ponzi's. I mean, Ponzi's are in theory both. So what's your view on this? I mean, I personally don't agree in either one system nor in the other. I think both are based on a pyramid of money, fractional money, that can collapse, as we have seen several times. So I think we should all see a future on better money, better design of money.
All right, so thank you for the question. Now, I'll try to do this as fast as I can. So I got to give you 400 years of history in a couple of minutes. We did have a world in which, invention of Dutch, that you had full backing for the exchange, and it survived very nicely and it thrived. The problem is this: at any given day, the Dutch only needed about 10% of withdrawal from the vaults. So that simply meant when I demanded 1-for-1 for every sort of entry in the book, it was over collateralized by a factor of 10 to 1. And you got to ask yourself, why do I hold 10 more times asset in the vault than I actually need? So the Swede came up with the solution. You do fractional reserve. What that simply means is when you put $1 here, since I know I'm not going to need all the dollar to satisfy withdrawal at the end of the day, why don't I just extend more and more sort of a ability to float the money around than what is in the vaults? It worked fantastically well because you built leverage in the system. And as you know, leverage is the most beautiful thing ever invented. There is a downside to leverage. It amplifies beyond measure that downside, right? Imagine this. Facebook has lost what, more than 50% of its value? It needs more than 200% increase to get back to the high water mark. I'm pretty darn sure 200% is a very, very large bar to meet. So all financial system, ever since the invention of Riksbank's fractional reserve, are fragile. That's what I said. Fragility is the life of any financier. So you have to ask yourself, what do I want? Do I want a slow, stodgy, safe system, or do I want a fast, interesting, exciting, and at times very scary system? That's a moral choice you have to make. This is almost like a philosophical choice. I can't make that choice. I don't think anyone in this world can make that choice, right? The other thing, of course, is one of the beauties of the fractional reserve banking is that it allows much more effectively for maturity transformations. And if you consider the amount of loans out there, whether it's a mortgage, whether it's a car, et cetera, I would argue that 90% of sort of a rudimentary financial transaction has to do with some sort of maturity transformation. You make that system fully backed, it's going to collapse that market in a hurry. It basically says you need to basically wait to save for the entire house before you can buy a house. Imagine how many people in the world can do that. And it's not just the house. It's also the car. It's also the appliance. I mean, anything we do is with credit, right? It collapses the credit market. It changes how we live, or for that matter, how we don't live. So I'm not going to say that they're Ponzi schemes, but they're as close as you can get legally to running a Ponzi scheme and be successful.
This is the quote then for the social media. Thank you very much, Luis.
Thank you.
Ali, for the answer. Is there a final question before we go to the coffee break at this fantastic talk? Then we leave it for the discussion now that we have the answer. Thank you very much,
Thank
Ali,
you.
for
Thank you.
being here.